when IAS 36 impairment of assets is not applied. IAS 36 tells us that we need to test assets for the impairment when there are signs of impairment. They could be internal, so for example, a forklift crashed into the wall, or external. For example, the interest rates have risen. That makes discounted cash flows lower. That makes value in use lower. And that could lead to recoverable amount being below the carrying amount. There are also 3 types of assets that we have to test for impairment at least annually. This would be goodwill. This would be intangible assets not yet available for use. So for example, when you have been capitalizing development costs, you need to make sure that the project is still viable and is going to bring you at least as much as you have capitalized. And intangible assets with indefinite useful life. Not infinite like land. Indefinite means that we don't yet know. These 3 groups of assets are going to be tested for impairment annually. And testing for impairment means that we're going to compare the carrying amount against the recoverable amount, which is the higher of value in use and fair value less cost to sell. And that is going to be for all of the assets, but not really. Well, let's start. IAS 2 inventories. With inventories, we are going to apply net realizable value test. What would be the difference? Well, net realizable value test is the money that we're going to get minus whatever we're going to spend to sell those. It looks very much like fair value less cost to sell. But that's not it. Why? Because fair value is based on the primary market. Net realizable value is based on wherever you sell. And of course, in here, we don't have value in use. Let's talk about trade receivables. Let's talk about debt investments. In this very case, IFRS 9 is going to be applied, and we don't calculate value in use. We don't calculate fair value less cost to sell. Instead, we use expected credit loss model according to IFRS 9. Remember, when we look at the credit risk change to decide whether we're going to look within 12 months or lifetime expected credit losses. Then we are going to apply different rules for IAS 40 investment property. Because when investment property is carried at fair value, we don't compare it against the recoverable amount, because how would we compare fair value against fair value less cost to sell? That would be strange, right? We are going to ignore IAS 36 for non-current assets held for sale, which is actually the criticism in here. Why? Because with non-current assets held for sale, we are going to compare the carrying amount against fair value less cost to sell, so just like one part of the recoverable amount, because we are not planning to use this very asset. But the funny thing is that when you are going to apply IAS 36, you are going to take the higher of fair value less cost to sell and value in use, regardless of whether you are planning to sell, we are planning to use, and so on. So in this very case, your decision as to what to do with those assets is ignored. But with IFRS 5, non-current assets held for sale, you kind of apply this this idea that you are planning to sell this very asset. So just one portion, only fair value less cost to sell, is going to be taken into account. We are going to ignore the rules to deferred tax assets. Well, remember, there's totally different logics there. We are going to look at the extent at which it is probable that the taxable profits are going to exist to utilize the unused tax losses. So, IAS 36 will not be applied to quite a few items in our statement of financial position. And why would it be important? Because when you are going to impair assets, quite often you are going to impair not just a single asset, but cash generating unit. In this very case, you are going to take the impairment and then you are going to allocate it. And those cases that we have just discussed, and a couple of more cases, they are not going to be participating in this allocation. So, for example, if your accounts have property, plant, equipment, intangible assets, trade receivables, and inventory, then the impairment is going to be allocated only to property, plant, equipment, and intangible assets, not to inventories, not to trade receivables, because IAS 2 and IFRS 9 are more important, are more specific, detailed than IAS 36. And that is what you need to remember when impairing cash generating unit. And I will see you next. My name is Lilia Kirilenko, and please subscribe and share this podcast so that more and more people would pass SBR with confidence. Bye!